Is preparing to go live. Going live in one, two, three, I guess. Awesome, Chris. We are live. How's the day so far? How have you been?
Doing great. How is everything over at your end?
Busy, real busy. Uh,
Always good.
I have a good news that I passed the EA part two, so I have one more part two.
Yes.
Absolutely. So I am hoping to schedule that next part late next month, and by the new year should be ready for everyone to serve.
Awesome. Well, that's quite an accomplishment. I remember trying to pass the tax portion of the CPA, and that was a bear. So my hat's off to you, sir.
Absolutely. I mean, CPA is a little harder than EA, but EA focuses more on regulations. I know
Yep.
CPA focuses more on numbers, but
Yeah. Well, what I tell people is that with the actually, I tell people that I'm good at math, so I go into accounting. Well, accounting is actually rules. So if you're good with rules, then you're going to be okay because we're holding something in our hands that can really do the calculations for us. So
absolutely,
get good with rules and also working with people. Like you and I, when we're working with our clients, I mean, you can be a great technician, but if you don't care about your clients like you and I do, then you're not going to get very far. So it has to.
absolutely,
There's a lot more than just I know what number to put where.
absolutely. I mean, that's a great thing you just brought up. One of the biggest things I realized that people will go extra mile for better service, even though it's from an average knowledge person.
That's true.
And I have seen that again and again. There's a very interesting book, even though that was in a hospitality industry, by one of the founders of Michelin Star Hotel in New York. I forgot the exact name, something in the lines of extraordinary service or something.
I think I know the book you're talking about. Yes.
Yes. So it's an interesting thing what he spoke about in terms of story is even though, if I remember correctly, the story goes something like that, that one of the clients or the customers were from outside of New York. They came in and said that, hey, we have not had a New York burger at a Michelin star hotel. And the owner literally went across the street, bought a burger, and brought it to them.
Mm,
Did not think that, hey, it's going to lose my business. But what they thought his focus was, how can I serve my clients better? Even though
exactly.
that burger was not in his menu, he
Yeah.
literally went off to go from a street burger to bring them, serve them on a five-star situation. That spoke a lot. I feel like that taught me a very interesting lesson that, hey, that's why I always tell my people, even the viewers, that we are average human being. There's might be
Yep.
situations that you, me, or anyone in my acquaintance does not even have any clue about some tax strategies. Okay,
Yep.
if you bring it us up to us, we know where to look for it,
Yep.
and we know we can go beyond to actually have those sorted out for you.
Absolutely. So it's really how much you want to serve the client. And what I tell people is that look, if your CPA talks to you like you're stupid, it's time to fire the stupid CPA. So you'll probably hear that more from me over the course. But yeah, like Tusif and I say, and when I say talk to my clients, I say, look, always ask me the question. Because one, if I can answer it for you, you feel great. You tell people how wonderful I am, and I can get more clients and serve more people. But if I don't know, I can look it up and get smarter.
Yep.
So, and I mean, you probably have a tax guide sitting around. It's out of reach for me. No, it's at the office, but I mean, it's like 3 inches thick, but that's not even the whole tax code. So
Yes.
there's probably something in there. I say, look, if you go out with your buddies and you go, to a night on the town, you have that one person who always imbibes a little too much, they just look at you and say, you know what, you should get an alpaca because that's going to be a huge tax break for you. And then what you do is you call me the following day and say, hey, Chris, my friend and I, that guy was telling me we were out last night and he says, hey, buy an alpaca, it's going to be a tax break. Is that true? I said, well, first of all, let me ask you, how many had they had? And then, no, it's probably not the case, but I've never been asked that question. But if anyone has questions about the deductibility of alpacas, please talk to Two Step Fry and we can do the research for you.
As a matter of fact, interestingly enough, I was talking to a Canadian client. This gentleman is from Canada. He's trying to expand his business in US. And as a matter of fact, he was asking a lot of benefits that USDA provides. I know there's some elements from the real estate perspective that we're going to be talking about today a lot. But I felt like when I was reading through the US code on the agricultural benefits, which is Schedule H, Schedule F, I think, not H, sorry,
F,
Schedule F.
F for farm.
Schedule F, I'm like, okay, they are there, but when I was initially studying, it was not a huge break. There was some elements here and there, but it's not something that is going to make you jump up and down to start a farm business.
Gotcha. Exactly.
And that's what I actually told them. But there's some states, though. As a matter of fact, I was going through some of the regulations in different states the other day. In Hawaii, there was a regulation a few years back, is if you had a tree, a specific type of endangered tree, you could get tax credit for that up to, I think, $2,000 or tax breaks.
Yeah, and learning about that stuff's kind of the fun stuff. You kind of look and go, well, really? And you do things like the augustarule that we will talk about in the future, and it's really you get the people down at the Augusta, Georgia. It's really an international golf course surrounded by a small southern town. So you get 30,000 people coming in for the golf tournament every year. Where do those people stay? You don't have Hiltons all over the place. People rent out their houses for a couple days, and because the way the tax law is written, they don't pay taxes on that money that they receive because they rented out their house for less than 14 days. So you never know what's going to be in there. So that's why you talk to your CPA so you can see what kind of benefits you can get.
Awesome, absolutely. And as a matter of fact, we're going to expand a little bit more on this real estate industry. I know this is, I would say, the holy grail of US tax benefit. For average people to participate in any sort of proper tax benefit. And that's one of the biggest things that had me into real estate investing. I have been investing for the last couple of years now and have been learning a lot. I myself is looking to invest in a few more properties myself. But it's interesting that what I would love to talk to you about today is, first, let's focus on what are the types of taxes someone may be associated. And then in the next week or so, maybe depending on how much time we'll have, start touching upon from personal benefits. Then we'll go from investing benefits or renting benefits or even lending benefits. So let's start from there. That what are the very possible ways an individual can get hit with any kind of taxes associated with real estate? What do you think?
Well, of course, and really it varies from jurisdiction to jurisdiction, is you're going to have real estate taxes at your local city, county, state. It really depends on where you are and how they're going to tax real estate. And people, that's actually something around town that people will get upset about if they raise the property tax rates, or if they do an assessment on your home and says, well, your home's worth $1 million. Yeah, it wasn't like that. So the problem is that that's a very touchy subject and can be very subjective depending on who is setting the rates. Where we are in Manassas, that the rates are set by the city council, but the commissioner of revenue sets the value of the house, or you also have vehicles that they will set the price on. So that's how those are determined. So those are going to be the main taxes that you're going to face, but you also can get a deduction on your taxes for those to a certain extent. About 5 years ago, well, more than 5 years ago, President Trump signed in a law that raised the standard deduction quite a bit, almost doubled it. But within that, they limited the state and local taxes you could deduct up to $10,000 for a married couple. And the purpose of that was kind of to go back to the states and say, all right, you can no longer hide behind this deduction. You are going to have to face the music about your angry crowd not being able to deduct all the taxes that you've imposed on them. It hasn't really had any effect yet that I've seen, but if anyone's seen anything in the news about it, that's something that you can do. Plus, if you're renting property or rental property, you can deduct those real estate taxes. And actually, there's not really a limit on that, just going to be the passive loss limitations that you have on a rental property. So
That's awesome.
those are the kind of taxes that we're looking at.
That's awesome. Great. You touched on a very interesting point. An interesting thing I would love to add on to that is, especially when a lot of assessments happen, someone can go ahead and challenge those assessments.
They can.
There has been, especially having so many investor friends, there has been a huge spike in taxes in Florida.
Yeah.
And people are like, yo, we have been cash flowing those last year. Now the tax raise, including the insurances, it raised so much and it's becoming very tough for regular rentals. We're going to be going with more creative options, how the tax implications are. But as traditional ones, whoever have been buying 20% down or even 3% down for FHA did the 203K. And that taxes assessment shot up so high, even in Texas, that it wasn't cash flowing properly.
Mm-hmm.
And a lot of new investors come in and say that, hey, this has been, the property taxes has been this much, that the seller had bought this property for 100,000, but with depreciation, when they're going to be buying it at 500,000, county is going to come in and say, yo, your property price is high, your tax assessed value is not high. This is one of the biggest mistakes I have seen underwriting real estate, that a lot of wholesalers, beginner investors make, that they come in, they forget that, hey, the moment you're getting that property for 3 times more, even if it is the property assessed value is not 3 times more, it's significantly more than what it was 20 years back. So unless you consider that, it's going to be different for every jurisdictions. And another interesting point that you just mentioned about that $10,000 limit, if you're using it personally, that's a great opportunity for people living in high income neighborhood, because if you have that and if you have a mortgage interest, if you're having, like, I used to live in Herndon, Virginia, which where the property taxes and values have shot up real fast from 4 years to now. And my previous friend where I used to live in, they're like, their property taxes went up 3 times. So now what you can do is, if you're taking standard deduction instead of the 13,000, it can, or even 26,000, it might be crossing that. So you need to sit down and look into those 2 statements, that you might be able to get better deductions on itemizing it just with your home.
Right. So I always go with what's going to put more money in my client's pocket. If it's a standard deduction, great. And sometimes, people kind of get upset, like, well, I don't get any benefit out of having this mortgage interest or the real estate taxes or the charitable contributions, which is all itemized. And I had a client of mine say, why give to our church, because it's not going to make any difference on our tax return. I think that he said that in front of his wife, and I think he's probably still sleeping on the couch. So, but it's what is best for you and what is the strategy for that, so that you want to make sure you're above that level, but don't necessarily start giving money or taking on debt just so you can lower your taxes.
Yep.
The bottom line is what puts more cash in your pocket, including the effect of the taxes.
Absolutely. And in some cases, the economy we're in, I know people like Dave Ramsey is not very fond of us taking loans, and
Yeah,
but at the end of the day, think about for myself. If I were to pay rent, I would have been still paying rent, more rent than I used to be paying mortgage. I
yep,
mean, I agree with him to the certain extent that, hey, if all of us were buying everything cash, yes, U.S. economy would have been significantly stable. But hey, I didn't get to write the rules.
right. No, you just learn what they are so you can take advantage of them, like the Augusta rule that we were talking about. Just
Absolutely.
it's not so much. There's a gentleman who wrote a book called The Memo, and he basically says, "Look, I understand you have these rules, and they may not be fair, but know what they are. But also, the rich get rich because they know what the rules are and they know how to use them to their own advantage."
Absolutely.
There's a Stoic saying, "That which is the obstacle becomes the way." All right, you have this obstacle in front of you. What are you going to do going forward?
Absolutely. And that's a great opportunity for us to look into it. And you brought up another great point that if someone is investing into real estate, that entire tax becomes an expense.
Yep.
So as a business, we're going to go through the real estate professional status in the further stage, but especially if you're not bound by that passive loss limit, that entire thing becomes a tax deduction for you.
Yes.
So in some cases, if this specific property, or in some states, you have short-term rentals or seasonal rentals, like rentals in Alaska or Utah, where you have snow mountains, where people come in for 2, 3 months for skateboarding.
Yep.
So they literally, in some cases, have to keep their entire rental vacant for almost 6, 7, 8 months. And all of a sudden, the remaining 3, 4 months, it's 10 grand a month, 12 grand a
Yep.
month.
Yep.
So even though you're making it as a business concept, that might be your business expense. And if that makes you more money, you need to realize that, hey, you need to make an intelligent decision about your business. So that's a great point you brought up. Now let's talk about when someone is buying. Is there a transfer tax paid or any sort of county registration tax paid typically comes up?
Yeah, and it's really that's going to depend on your jurisdiction. Certain states will have it in certain counties that you'll see a transfer tax. I believe we do have one here in Virginia that I've seen on a few real estate documents, but really it's depending on where you're watching here. So when you're sitting down, you're talking to the real estate, the brokerage or whoever underwrites it, always ask that question to say, all right, well, is there going to be a transfer tax here? And then you will know that, okay, this is going to be part of it. What do I do about this?
Awesome. So then becomes, well, you mentioned about when it's living. So when it's living, you pay the county tax, however they're assessing it. Now let's come to the point of selling it.
Yep.
So if I bought a house at 300,000, I sold it for 500,000. What kind of taxes related to that comes into my plate?
Well, okay, so let's ask the question here. Is this going to be your primary residence?
Yes.
Okay, are you married?
Yes.
Okay, so it went up what, $200,000?
250? Yeah, the
250?
purchase price, yes, 200,000.
200,000. Well, that's great. You did a great job. No tax implications because there's something called the home. What you can do, I'm kind of tripping over my words right now, but if you're married and it's your primary home and you've lived in it for 2 years at least, and you haven't taken this exemption before, $500,000 is the gain exemption that you're allowed. So if it was you bought it for 300 and you sold it for 500, forget that. You bought it for 300 and you sold it for 799. that's a $499,000 gain. Hopefully, and if that went up, in the 2 years that you had it, we may have other problems. But you are still not, you will report the sale, but you will not have any taxes on the gain.
Okay, awesome. So what you have been mentioning is a great point for people who have been considering a property sale, downsizing as well.
Yep.
It's called 121 exclusion.
Yep.
Where the 121 code section actually implies that if it is a personal property, it can be derived as a primary residence. And out of last 5 years, at least 2 years, you have been primarily residing into it. The amount of gain, if you're single, that's $250,000, no capital gains, and up to $500,000, no capital gains if you're married.
Yes.
Of course, in that case, you cannot file married, file single.
Yeah, don't do that.
So even if you, unless you're actually divorced, legally separated, don't go for the married filing single because it's gonna mess up a lot of deductions. So
Right.
even
So
if
that's
you're
when,
thinking about
if you're going through a divorce, sit down, not only talk with the attorney, but your CPA, let them know this is what's going to happen. What do I need to be aware of? And there's implications when you're dividing up the property and how that's going to be handled. So
yeah,
always keep that in mind.
that's a great point you brought up. As a matter of fact, someone from my family actually had to go through that. Unfortunately, that's the situation that we face in society and life. But in terms of finances, we should be very cognizant of sitting down with CPA. Unfortunately, he didn't reach out to me before the sale. But after that, I was able to inform that, hey, this is the amount that you could actually not pay any taxes legally. Had we been able to settle this down before actually coming to this point. But make sure to consider that element as well. So in this case, is there any depreciation concern if it is a primary residence?
Well, no, well, it really depends on if you've used part of it for a rental property, and then the depreciation will have to be what's called recaptured. So you're going to get a tax. You probably, like, you'd had a rental property, so you get the benefit of it, the tax benefit of having the depreciation reducing the income that you earned while you were renting it. Or if you had a home office in there, and you can take some depreciation on that home office as part of the home office deduction, that's got to be paid back. So keep that in mind as you're going to sell, and then sitting down with your CPA before you make that sale. Hey, I had a home office. What's the tax implication? And get it out before tax time, so you're aware of it. And it's like, yeah, okay, we've got this, and we've handled you can do estimated payments on that. And I've had clients that have called me and said, hey, we're getting ready to sell our house. We had a rental. It was rented for a couple of years. Help us figure it out. And we figured out how much the tax was going to be. And we sent in an estimated payment for that. And then when we did the real return, it was, okay, yeah, we've already covered this. Let's move on.
Absolutely. That's a great point. And typically, that recapture tax is staged like 10%, 12%. But the good thing about recapture tax is capped at 25%.
Yeah.
So the highest you are going to be getting taxed is 25%. But that would also be on the part of, so as Chris has been mentioning, like a lot of the people, even when I first came to US, I rented a basement. So the property owner rented a part of his house to us. So that part of the entire square footage, they would have been able to take depreciation out. But when they're selling it, then same thing, that depreciation recapture of that portion is going to be taxed, but that's going to be capped at 25%. So if you are making money with your real estate, make sure to take depreciation.
Absolutely. And TUSIF, actually, just a warning to people who are renting out the properties, and don't forget about the recapture of the depreciation when you're getting ready to sell a property. I had somebody who had a rental property. They never took the depreciation. So they thought, Okay, well then, you know what? I didn't take it. I don't have to, I'm not going to be taxed on it. No. What the code says is that depreciation that could have been taken. So it behooves you to take that depreciation. So
That's a great
please
thing.
take it.
So that is a very interesting thing. As a matter of fact, we actually talked about this on our previous conversation on the stock option for C Corp. That
Yep.
if you can, if you, whenever you are giving or keeping the option to take cash or option to reduce deduction, that itself is a taxable event. So the moment IRS allows you to take depreciation, just take it. And say, for example, someone forgot to take, didn't know. Say, for example, they have been renting it out. They came to us. What would you do?
Well, there is a form, and the numbers escaping me, but we can come back and say, all right, we're going back and we're going to fill out this form. I think it's 1310. Tusif, you've been studying all this stuff, so you might know the number better than I do because you've been testing on it. I just would go look it up. But it does allow you to say to make up for the depreciation that has been missed. And I've done this for a client who had a rental property, didn't realize that, oh, well, I could have been taking depreciation. Thankfully, we're just a year or two in, so it didn't really affect anything that much. IRS was perfectly fine with it because they know that, yeah, you should have taken it, but we're going to get it back on the back end when you sell that rental property. So enjoy it while you can, sucker.
So, as a matter of fact, this is an interesting case with an elderly gentleman that I have been talking back and forth about. This is from a friend of mine who does wholesaling and who was in the conversation from an investor who was trying, old-fashioned old lady, didn't even know about depreciation in the first place. When he was trying to sell, I was like, hey, what should I do? So when they asked us, there was a very interesting thing that, yes, there is a form that you can take, but the good, the bad, the ugly thing. So the good thing is now that they are at the end and they're selling it, all the depreciation comes into play. And they're like, yo, we get a pretty good deduction. But on the other side, you need to realize that when the next year when you're going to be selling it, remember that depreciation is going to be recaptured. And the next element that you are going to be having is the capital gains. Just because you hold it for 17 years or 27 years, doesn't matter. As long as it's more than 2 years, it's good that long-term capital gains rate, which is going to be capped at 0%, 15%, and 20%. That's why I was talking to another friend of mine that, hey, do not sell. If you were thinking of selling, you wanted to rent it out, put a balloon payment, whatever, that's great. Do not transfer your deed before the year one.
Yep.
Because that moment it becomes a short-term capital gains. Whatever you fix it up, you bought a beaten up property, you fixed it up, that actually raised the value significantly. Now, if you're selling that difference of price, just because it's not a purpose of flip, that's a very interesting thing. I want to clear that, Chris. You can actually also chime in that flip is considered as a commodity transfer.
Yep.
Not a capital transfer or capital sale.
Yes.
So if your intent is BRRRR method, which is buy, repair, rent, refi, repeat, your purpose of that purchase was rent.
Yep.
Then it becomes a capital asset.
Yes.
If it is the purpose or intent of that property is to flip it, it is not a capital asset.
Yep. It's like just like you're buying a stock, really.
Absolutely. Buying a car for sale.
Yes.
Buying or flipping couch. That Gary V promotes a lot that, hey, when he started, he flipped a lot of couches, which is great. But of course, that's not a capital asset for you. But what it might have been for if there was a car dealer, if his things were sitting down for more than a year, that's a different conversation we would have to have.
Absolutely.
Flipping those properties, that's not a capital asset. Okay. Now let's talk about the nitty-gritties of the capital gains you just brought up. So help us understand, Chris, if someone bought a property at $500,000, they put
Yep.
20% down.
Yep.
Okay. And they sold it for 510 or 550. What is their gains?
Okay, so it's going to be what the purchase price. So you said 500,000, they put 20 down.
20% down. So that's 100,000.
20%, 100,000. So, and then they went and they sold it for how much?
550.
550. So the gain's going to be the 50,000 that you had. You had 500,000 versus the 550,000. So the gain you had was on 50. The mortgage doesn't play into it with this. And we've run
Absolutely.
into a lot. It's so, okay, yeah, you only get 100 down, but you made 50, you pay everybody back, and you've made a little bit of money on that.
Okay.
So, yeah.
So the reason that I wanted to bring this one up is this becomes really interesting when someone is selling it as a subject to transaction, is when, say, for example, the same thing was sold at 550, but they were allowing other people to assume the loan or take it subject to.
Yes.
Now the interesting thing becomes a conversation of what is the basis of the property.
Right. So it's you're really one tax thing to think about, if, and this is kind of I'm going to digress for a second, but if you have some stocks that are real losers and you want to get a tax break, you sell the ones that have dipped below what you bought them for, you get the cash, and then you can take the loss on your return up to $3,000 a year. So what happens is when we do what you were just talking about, was that as long as you don't exceed your basis, that's just a return of your investment, really. So there's no tax on
Absolutely.
that. It's only when you get it back for more than your investment that you're going to see, because that's when you actually made money.
Absolutely. So here's an interesting scenario that we can have a conversation on is, say, for example, in that transaction example, someone told that, hey, I'm going to be giving you $100,000 down. I'm going to take over the mortgage or take the property as subject to. So that means that loan is there. And the remaining $50,000 is going to be seller finance on 5% interest. So let's talk about that issue now. The reason that in real estate I'm bringing up these examples is since I'm part of a very diverse creative finance group, so these issues always come up. So I wanted to help people out on specifically these concerns, because this is a very common scenario, is the moment someone brings up that exact same scenario up to that 500,000, this is something called the basis.
Yes.
So what it means is how much did I materially participate in this property?
Exactly. And your basis could be increased. Say that you made some improvements to the home that are designed to improve the value. People ask me, well, what is that normally? And I say, well, you watch these flip shows, what causes a huge argument between the flippers? That's usually something capital, replacing the roof. Or like if you're doing your own home, what causes an argument between you and your spouse? Redoing the kitchen, redoing the bathroom, putting in a new HVAC, putting on a new roof, putting in a spa in your bathroom. Just the big major things that are going to increase the value of the house will add to the basis.
Absolutely. And an interesting thing to add here is if someone went in and did regular maintenance, that is not basis, that is an expense.
Exactly.
But the moment they took, say, for example, as you just mentioned, maybe major equipment, they added a sauna in the backyard. They added a huge, long, circular driveway.
Yes.
Those are not expenses. If someone came in, they want to say that, hey, I want to have this I spent $20,000. I want to write off $20,000 this year. No, unless this is a this is an expense, which is regular maintenance. Regular maintenance can be written off entirely on the same year. But the moment it becomes a capital expense, capital addition, adding a new room, that is something that's going to add to your basis. What it means is when you sell it, say, for example, you added another room, which increased your value from 500,000 to 515. Now your capital gains becomes $35,000 in the same example. So you're not going to be paying taxes on the additional $15,000 when you're selling it, but for you to actually take it against your taxes, you have to depreciate that.
You do. And something to keep in mind that when you all are doing things to improve the house, make sure that you divide up the bills. So if somebody's working on a capital project, redoing the bathroom, but they're also like painting the living room, don't have them give you one bill. You may have to be a jerk about this. Say, no, I want a separate bill for these items. And that's the only way we're going to do business, because you will be able to take an immediate deduction for the painting of the walls, because that's repairs and maintenance. But as Tusif had said, the capital ones you're going to have to depreciate, and it's going to become a part of the capital value of the house.
Yep. And as a matter of fact, even I personally was a victim to this. That's why I bring it up.
We're human, folks. We get it too.
So when I first was into real estate, I did not have all those tax knowledges.
Yeah.
And I ended up having a big, long conversation with another CPA, like, hey, why can I not deduct it when I just spent so much money in fixing this property up? And what if I take loan against it? Same thing. On the loan side, you can write off the interest, the taxes, insurance part, but the principal goes to your basis.
Yes.
You cannot take a reduction for that.
Yes.
So I had to wrap my head around personally for quite a bit of a while, up until the point, to be honest, I recently have been getting into the IRS trenches of codes. That's when I now more understanding of what actually should have been done and what are more on the capital expenses.
Right. So it really, that's why we keep harping, and we will keep harping on this through the series, is talk to your CPA. We will take those questions.
Yeah.
Because, most of the time when people are selling their houses, usually that's when schools are out. I mean, Tusif, the rental market, the real estate market better than I do, but it's not going to be during tax time. So not that we're bored or anything, because we'll be working on some other things, but we're not going to be as stressed as we are, say, in March or April. So, hey, sit us down, talk to us. Hey, maybe take us out to lunch, get us a nice, good halal sandwich for Tusif.
I love sushi as well.
Sushi would be great as well, and ask us the questions. I will take a good steak sandwich. I met with a client today, and he bought me a good French dip. So, not the plug for food here or anything.
50% of it is deductible.
50% is deductible if it has business on there. But hey, folks, sit down and talk to us. Ask us the question, because we get it taken care of now. That means a lesser chance of an IRS notice later.
Absolutely. Awesome. Today was some of great conversations, to be honest, especially on those aspects. So let's dive into that other aspect that I just brought up in the same example. So we're probably going to be going back and forth in this 500, 550 example, just to make these numbers easier. All right. So say, for example, that $35,000 now is now, let's make it a little more complicated. Not 35, but $50,000 that we actually said that from purchase price to the additional price, with additional of that $15,000 room. Say, for example, we're getting 5% interest on seller finance. What would be the tax implications there?
Well, a seller finance is just kind of a different animal there. And so with seller financing, you have the installment sale. It's just really with an installment sale, you're just going to say, all right, so I'm only paying a certain amount. So if you're if you've made a gain on it, you're only going to be taxed on that portion for that of the payment that you're making. So if you have that $50,000 gain, but it's going to be spread over 10 years, that's the only part of the gain you're recognize is the $5,000 plus any kind of interest that you're going to pay that plays into it. So it may behoove you to do an installment sale. And like I said, again, harping on this, sit down, talk to Yusuf and I, and see what can be done.
Absolutely. And you brought up a very good point, is installment sale. IRS has a big section on installment sales.
Yes, they do.
Like, a couple of the reasons is people tend to sell it to themselves or their family members at zero interest. And IRS is like, you know what? I don't like zero interest. Even though Dave Ramsey, doesn't matter what Dave Ramsey thinks.
Dave Ramsey ain't a tax guy.
So even though Dave Ramsey doesn't like interest, IRS, even if you do follow him and say that, hey, I want to sell it to my friend at zero interest, first thing IRS is going to come in and say that, slap on your hand and say that this is the imputed interest.
Mm-hmm. And so you might as well charge them the interest rate. They're going to say, this is the rate, this is a government rate, charge that rate.
Yes, because the seller eventually would have to pay taxes on it. Unfortunately, yes. And in the same scenario, as Chris mentioned, on this element, this example that I just brought up, there's going to be 3 elements to it. First of all, on that additional room, that $15,000 goes to the basis. So that basis fundamental is not taxed.
Yes.
But the interest that you're getting is taxed.
It is.
So that first element of taxable interest. Second part is the remaining $35,000 over a period of 10 years. That becomes $3,500 a year.
Yes.
That's the second part of tax. If it is after 2 years, after 1 year, then you're getting out max 20%. And in this case, most likely 35,000 is at 0%. So you're not going to be paying any capital gains tax. But on the interest side, that is going to be taxable interest. So whenever you are doing a hybrid deal, guys, think of these 3 taxable elements.
Exactly. And really, again, slow your roll. Talk to Yusuf right before. Say, I need my CPA to look at this. He's going to flip. I mean, look, I say to clients all the time, look, if you have a deal, but you're not sure about it, sit down and talk to us. We will put on the black hat. The bad guy in the cowboy movies always wears the black hat. We will put on the black hat gladly, as long as it's protecting you. So ask us, and we can squash the deal if necessary. If my CPA said I can't do this, hey, we will be the bad guy. That's fine. I'll sleep well at night.
It is so powerful if people are not leveraging this negotiation tactics. Even if the higher authority in negotiation is such a great tool bill to have. Like, you want a price, the seller is like, no. You want the property, the seller is like, no. But he's like, hey, I want this much. That moment you come up with that, hey, I want to give you that 500,000 when you want to give him 350.
Yep.
But that moment you bring us bad guys saying that, hey, I want to talk to my CPA.
Yes.
And in the end, your CPA comes up with the tax implication, or even maybe we can structure something that's going to be best for them and you.
Yes.
Then they can get their $500,000 with other taxes that coming down to the zero. That means they're keeping more money to themselves. You're essentially helping them, but that pressure of negotiation at that specific moment goes away from you. Right.
You use it. I mean, use us. It's kind of what we're here for. We are here to serve. So
absolutely. So I know we're getting towards the end of this show, but I want to touch base on a very interesting element. Is if we are selling these properties and instead of regular sale, we sold this and instantly bought another similar property or a bigger property. What
Yes.
happens to the capital gains and the depreciation recapture or the interest in that case?
Well, so you're bringing up something that people are going to throw around at cocktail parties. Like I did a 1031 exchange.
Yep.
So that's what Tusif here is talking, kind of dancing around and said, Chris, you threw out the number 1031 exchange. So basically, there are rules around it, and there are quite a few, and we'll walk you through step by step of these when you sit down with us. But you have one property, but you have this eye on another one, and you want to say, all right, I want to get that property. So you basically trade properties like you used to trade baseball cards when you were a kid. So what happens is, but the thing about it is you need to use an intermediary who focuses on 1031 exchanges. It can't just be swapping with Bobby down the street. We're going to swap houses. So you need to go through an intermediary to make sure everything's above board. But what happens with the taxes is that they get pushed down the line. And if you keep doing this down the line, eventually till you pass, then what happens is that the value of the property at the date of your death is going to be the value that your heirs will get it at. So when they go to sell it, the capital gains will be much less because, say, Tusif went out, or I'll use it. My parents bought a home in Virginia, Vienna, back in the 80s for about 190,000. I looked it up the other day. It's now $1 million property. They no longer live there, but if they stayed in there and just deeded it out to the kids, and when they both passed, we have $1 million property, we would go and sell it, say for $1 million, $1,000. The capital gains on that is $1,000, and we pay
Awesome.
three whatever the taxes would be, whatever our rate is, or
So
like $150. So we would basically split it between my siblings. We get $333,000 tax free.
that's awesome. And what happens to if they say, for example, your parents took depreciation, what happens to the recapture tax there?
It just moves on down the line, and it really depends on what you use it for going forward.
So, say for example, your parents have been 1031 exchanging. They're one of the best investors in the entire United States. So, God forbid something happens to them, those property come to you and your siblings.
Yes.
You have no idea how much they depreciated that for. What happens then?
Well, you need to do you will need to do some property records to see what exactly happened. You can't just assume and say, well, I don't know. But your real estate agent, and really now, I mean, back in the 70s when, my dad was active and doing things as far as first CPA, what have you, he, Tuesday, if I could probably show you some of the forms that he was working
I can
on, but this
imagine.
is being done pen and paper. And all this, we use technology here, and I'm just stunned at like, wow, my dad actually had to do all this by hand. But now you don't have the excuse. You can go back and see what the property records are and what it was, and you can pretty much find anything. So you can go off of that. What have you found out about that, Tuesday? Because I know you were studying for the EA, so this is more fresh in your mind. What have you found out?
I guess, of course, there's a couple of elements on this specific situation. As much as I have understood, of course, I'm still digging into it. The capital gains, as you just mentioned, starts from there. And all the previous gains are pretty much up.
Yes.
And the moment the gains are up, in my understanding, the depreciation recapture also is falling with it. However,
It is.
I am not going to quote on this specific case. I'm still studying on this specific area to jot out the more nitty-gritties. I can definitely dive deeper into it. But my understanding so far
that's what I was talking about earlier. That's not a situation I have run across, but if it is something that happened, we can look it up and let you know this is what you need to do in a situation. So don't sell grandma's house before you come talk to us.
Yep. And as a matter of fact, I know we're going to be talking in depth into it next episode. I just wanted people to have a rough idea. As a matter of fact, I am in this chapter. So
yep.
Of IRS code I was looking into for as a matter of fact, my next portion is business. So business is going to involve a lot of these calculations. But as you just mentioned, that entire capital gains going away. So pretty much all of that goes away. But the remain interesting thing that someone needs to consider is the gift tax, estate tax. We
Yep.
are going to be going over those in the next episode. We're not going to go start that entire can of worms at this episode. But make sure, so let's stick for this episode, let's stick to the aspect up until the individual dies.
Yep.
So on next episode, we're going to be diving deeper on a more concise and precise answer to this situation. Is up until the death of this individual. Say, for example, someone buys a $500,000 property. He recognizes a $100,000 property gain. And as Chris was mentioning, if it is with a certified intermediary and it is within the time frame, there's two limits, if I remember correct, 45 days, 180 days.
Yep.
Those two limits, and in some cases 90 days, 180 days, on the first one being selection of the property and the second one being closing of the property, it actually pushes the entire opportunity for you to pay those capital gains taxes. And also all the taxable events associated with it now pushes back. Now, as a matter of fact, I was talking to another very good friend of mine from New York who was like, hey, what if we could do a 1031 exchange, buying a property at 300,000 and selling it at 300,000. Well, I told him that, hey, you can do that, but the issue is, what are you gaining?
Yeah.
What are you?
Don't go through a transaction just for the tax benefits, because you're putting yourself through all that work for nothing.
Yeah, because you still have to pay for the intermediary.
Yeah.
He's not going to do anything for free. So you're actually losing money.
Yeah.
Because if you're buying a property for 300 grand, selling it for 300 grand, what you're doing is you could have, as we have been mentioning, you could have been taking it away just as basis tax free.
Exactly.
And the fundamental aspect of you're actually putting money into cyclically bigger and bigger deals is that eventually you are at a point of life that you're going to be passing away and not paying those taxes. That's how rich are not paying taxes.
Yes.
So
it comes up every year about the rich passing on their stuff. Well, again, we talked about earlier, they know what the rules are, they take advantage of them.
And even if they don't, they hire people like Chris.
Exactly.
So you need to realize that what it means to work with someone that's efficient.
Yeah.
And that's where I come into play. We are going to be discussing more into trust. There's a lot of options with spendthrift complex trust. We will be going through those as well in a future videos. But for now, for someone without all these complex tax protection structures, if you were to even be yourself, US code allows you to buy these properties under your name, straightforward. But it's preferred that you put it under LLC or S Corp so that you still get the flow through depreciation, but have some level of legal protection, as we spoke about in our first episode.
Absolutely.
And also, we always recommend keep separate accounts, and as Chris's 5 commandments, document, 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 document. As a matter of fact, if you don't keep, I was helping another friend of mine underwriting I think it was 46 unit or something unit, and the people that was keeping records was so off.
Oh boy.
We were off almost $70,000. So how can you be $70,000 off on an income?
It's beyond me. And really, it's business people when they go in, they say, well, should I get an accounting system? Absolutely, yes.
Yep.
And the benefits now of that is that any transactions that come through your bank are going to be captured in there so that you can really just you will have it. And what I say is that it downloads it and you can pretty much do your books in like a quarter of a football game.
Yep.
That's it.
And if you are so cheap that, hey, I don't want to pay for that, at least do it yourself in a separate way.
Right. Just make sure it's, I've been through things with the IRS that the guy had everything all lined up, and it was the easiest audit that there ever was because the auditor could not argue with us because we had the proof sitting right there.
Absolutely. And especially with all of those new pushes coming up, like the bonus depreciation reducing now. This year it's going to be 80%. It's reducing now. If someone is pushing for that real estate professional status and this bonus depreciation status, IRS is kind of getting fishy about it.
Yep.
So if you're not keeping your proper books, trust me, it is going to be a heck of a difficult time. And you might even go down the rabbit hole that, hey, you can argue, you can submit your cases, go all the way to Supreme Court. I mean, if it is less than $25,000, you might have as well not have the chance to go to the Supreme Court because
right.
It's going to be considered as a small tax issue. And the moment tax court does it, that's it. You cannot appeal.
Yep.
And in those cases, you just lost an opportunity to keep your 25 grand, which most likely than not was supposed to be yours.
Yep.
So that's why I love the way Chris says 5 commandments: document.
Yep.
Put it in your mind, and that's it. All right. So I appreciate your time today. Just to summarize what we have discussed today so far, we have discussed what happens before you sell. That's transfer taxes. That's what you might be subject to. What happens when you're in the property in real estate, which is city or local jurisdiction taxes. For personal case, that is not deductible more than $10,000 if you're married, filing jointly. For business case, it is fully deductible. Then comes to the point of sales. If you're selling your primary residence, which means your 121 exclusion with living in the property for 2 years out of the last 5 years, then you get to have $500,000 of capital gains tax-free. But of course, in that case, you still have to have the depreciation recapture taxes because depreciation recapture is something that ours does not want to let go. But on the other hand, if it is a commercial one, your business property, then you don't have that exclusion, but you end up getting the 1031 exchange, which pushes that capital gains. And we are going to be on our next step. We're going to be going more into capital gains on 1031 exchange, looking into the depreciation side, recapture side. But on the previous element of sales, we spoke about what happens in the sale of a creative sale, which is traditional way, what happens if it is a business, how the capital gains works, if it was a subject to sale, and if it was a seller finance sale with an interest with or without it. Anything I missed, Chris, or anything you want to add before we let you go?
No, I think that you got just about everything in there too. So that was a great summary. But we'll be going more into this, and if there are questions that you have that you want us to cover, please put something in the comments saying, "Hey guys, can you go over this?" And we'll certainly put it on the docket.
Absolutely, we would love to. Awesome. With that, I know we have a lot to cover in the series, so stay tuned. Make sure to subscribe or put your comments below, even questions. And we're just regular people. We forget our form numbers. It's okay, but we always look it up. Indeed. And when we're going to be having a conversation, it's going to be a genuine conversation. You're not going to be talking to AI or a robot. So both of us are family guys. We're just going to be as a human being, we're going to have a conversation. With that, I appreciate your time, Chris. It has
Yusuf,
been a
it's
very
always wonderful
productive.
sitting and have a conversation with you. So let's keep talking.
Absolutely. It has been a wonderful episode again. Thank you very much. Thank you all. And we'll